All right, welcome to the High Rise, where we talk about cannabis MSOs, products and market analysis. It's a laid-back and data-backed discussion on all things cannabis. My name is Cy Scott. I'm the CEO and co-founder of Headset, and I'm here with Emily Paxhia.
Hi, I'm Emily Paxhia, and just like the show, I would say I'm laid back, but also data backed.
Awesome, and I'm here with Matt Karnes as well.
Hello from New York. Good to be here.
All right, so today we've got a number of things to cover. Some Canada news as well as some US MSO news, just to kind of reviews. The first thing I think we want to talk about is in Canada, kind of some US CBD strategy. Recently, we talked about Canopy and Southern Glazers announcement, where Southern Glazers will be distributing their Quattro CBD beverage, which is pretty interesting. Southern Glazers actually also distributes cannabis products in Canada, obviously the largest alcohol distributor in the US. So that's a unique kind of outlet for Canopy Growth to kind of come to the US. But more recently, just this week, we saw Valens acquires GreenRoads. And with GreenRoads, this is the number 2 CBD brand, according to the press release. They acquired this company for $40 million, which is 1.8x 2020 EBITDA. So, just kind of another CBD strategy coming from a Canadian operator. This one's a little different than the distribution play with Southern Glazers. Kind of sounds like Tilray Manitoba Harvest. I know Manitoba Harvest has a footprint with some CBD products, some tinctures. I don't know if those products are actually sold in the US. I do know some of their hemp-based products, like their hemp milk is sold in the US. So how do we feel about that? Is this a good strategy? Is this the only way that Canadian operators can come into the US to build a brand? Is it a good revenue opportunity? Is it something else?
Yeah. I'll just jump in. I mean, it feels to me like the Canadian operators are just continuing to look at any way they can possibly start to get a toehold into the US as the US market continues to just prove to be so healthy and growing, especially on the cannabis side. But I think it's important for investors to understand and people to understand that cannabis markets and CBD markets are in completely different animals, and that they function differently. They sell through different points of sale, and they have different regulatory frameworks that kind of either create moats around the growth of the business and protection of the business, or create opportunity to scale massively. I do think it's interesting that they said it's the number 2 brand in the United States, because that would mean there's a pretty big difference between where they sit and where like Charlotte's Web or CW Hemp sits, which I believe came in around 100 million in top line revenue for 2020. And the other thing to note is I would dig in to understand the EBITDA around that, because a lot of these CBD companies really struggle to drive any EBITDA, if any at all. And just because the margins are really, really tight in the US, and the pricing, they're trying to command pretty high prices for the products, but I don't think they can really quite get there to drive the margins they need. And just one last thought on the Manitoba Harvest. We were actually investors in Manitoba Harvest way back in like 2014 through, or 2015 through Compass Diversified Holdings, which was a diversified holdco. They were very bullish on the future of nutritional hemp, and so that was how they participated. We were very bullish on it too. I'm also a plant-based eater, so for me, I use nutritional hemp instead of soy if I can, for protein and fiber. But I don't know. It just feels it's a very different category. It grows very differently than cannabis, and so even though it's from technically kind of the same plant, it's a very different business model. So it's important for people to dig in and understand the growth patterns around that, and also understand that Manitoba Harvest has been around for quite a long time, so it may have a different growth trajectory than these high growth consumer or cannabis packaged goods, as you referenced them, Cy, on the cannabis side. So it's not all the same.
One thing also to kind of complement the Canadian interest, if I'm not mistaken, I believe Clever Leaves has a play into the CBD market in the US as well. So there is sort of a heightened level of interest, I think, around the CBD. I'm sure it's obviously going to be very big worldwide, but it would be interesting because by and large, everything in South America is produced a lot less expensively than in Canada. So I would put my bet on the South Americans and the opportunities that they'll be able to come up with versus the Canadians, where things are much more expensive.
Yeah, fantastic. And I feel like we'll see more news like this ahead as the Canadian operators. The Canada growth has been relatively slow for traditional cannabis products, and getting U.S. exposure is pretty important. And the sooner they can do it, the better. So this does seem to be one of a few different plays that they can make. So in other Canada news, Sundial upped their investment in a joint venture to invest in strategic financial and operational partnerships targeting asymmetrically enhanced risk-return opportunities in the cannabis industry to provide exposure to a portfolio of attractive debt, equity, and hybrid investments. Oh my gosh, that was a mouthful. So, if for those that remember, Sundial, may have been kind of one of these Wall Street bets stocks for a moment. If we all remember the GameStop craze, and they brought in a lot of capital, and it seems like they're putting this capital to work. And this is another interesting strategy, I think. Right, put this money into a JV, make some investments in some companies, a variety of different companies that are asymmetrically enhanced, as they say. So. Is this something else? Will we see more capital being put to work like this model that Sundial's coming out with?
I would just say broadly, I can't help the pun, it's coming, but joint ventures in the cannabis industry are probably going to be more significant as time goes on, especially as companies or everybody's dealing with interstate commerce and so forth. But I couldn't help the pun, so sorry.
I know. Matt, when you wanted to call this podcast, I was like, no, honey, I can't help it. I think look, they went public. It wasn't a great reception in the public markets. It's been a tough fall for them. They've had some recalls. It's not been a straight line up like some of the other, well, none of these companies have been a straight line. It's a tough road to hoe. And so I think that, they raised money during a crazy cycle thanks to Wall Street bets and the people who jumped in on that. And I think they're trying to now bolster their business by buying revenue, by buying companies that contribute positively to the business. And if you can't build it, buy it. I don't know. They have the access to the cash.
Yeah, who would you buy for 180? If you had $180 million, what do you guys think? Would you buy technology, ancillary type company? Would you buy another plant touching company, a US CBD company, all of the above?
That's a really good question. And there are a lot of variables. I would say at this juncture, I would invest in some type of business that could also serve in other industries, not just be limited to cannabis.
Oh, so like the Sweetwater by Afria.
Pathogen, the lab testing where they're doing like the testing for all kinds of other different attributes in agriculture other than cannabis. I don't know too much about the company, but generally speaking, I think they would be able to serve outside of cannabis. But I mean, obviously, we're still at such an early stage that depending on the state and the market, plant touching businesses would be really attractive. It just really, I would have to see, a lot of things.
Well, are you saying if I was a Canadian operator, who would I buy, Cy?
I don't know if you're a Sundial or you run this JV, right, and you need to make some investments. Would you got almost $200 million to spend?
Yeah, I would invest into a Latin American operator that's vertically integrated or GMP certified and flip my manufacturing business into that region and completely improve my cost structure and then distribute internationally as well as into Canada. So that's what I would do. In other words, I would not be growing and manufacturing cannabis in Canada.
Right.
Oh, yeah, for sure. For sure.
So
who would do that?
I would invest into Mexico or Colombia or Portugal and flip the whole script on it. Take that money and get more bang for it.
I love it. Sundial, when you need some help, give us a ring. We're here for you.
You know who to call.
So on to U.S. and MSO news. Busy week in the news as always. First, Columbia Care. They made an investment into a new greenhouse in New York, a $42 million purchase. I feel a bit of an echo from, again, the early days of Canada when everyone was buying up greenhouses. This pretty recently, Canopy Growth made some headlines around shuttering one of their greenhouses that they acquired in British Columbia, 3 million square feet. This one with Columbia Care is 1 million square feet, so 3 times the size in BC, which they had bought for 500 million Canadian and divested for 40 million Canadian, which, is just a little cheaper than, what Columbia Care is buying in New York. So to me, this, feels a little like deja vu in a way, right? Emerging market, New York. The legalization framework hasn't really been laid out. When a lot of these investments were made in grows in Canada, we didn't really know what Canada was going to look like. We didn't really know what the framework was going to look like, but people were gearing up. This is happening in New York, but I do have to believe that New York is going to be a very sizable market, and New York, has a lot of other U.S. markets to look to kind of roll it out effectively. But is this, a sign of things to come for New York? Are we going to see more investments like this? Last week, we talked a bit about Pennsylvania. We talked about $250 million going into Pennsylvania. Not all of that was in grow, but a lot of it was in infrastructure. And do we think there's going to be a big race to see how much square footage you can get in New York in preparation for adult use legalization?
See, I'm sorry. I was just going to say, this is the thing. At this juncture, I think companies have to be very mindful of when the tide is going to turn and when interstate commerce will be permissible. So, does it make sense in New York to just like overspend and build, when perhaps, from what I understand, there's a cooperative agreement in the works, perhaps, in between New York, New Jersey, Pennsylvania. I think all those kind of things have to be figured out before, anybody really pulls the trigger hard. But like this is also on the heels, don't forget, if I recall correctly, GTI is going to convert a prison into a grow facility. I can't remember the square footage, but, there's also a lot of capacity, in the Northeast. There's ACAN. I don't know if you guys are familiar with them. They have like a huge indoor cultivation facility. What's going to happen to that? Will that be utilized somehow? And I don't know. I just think there's a lot of things a lot of moving parts. And this is where it gets exciting, because I think this is what's going to differentiate the real winners from the not so much of a winner situation, to be able to navigate through these challenges and these like obstacles and these like uncertainties.
Yeah, I mean, I'm a bull on New York. I think that every market that's open so far has been undersupplied. Almost every market has been undersupplied, and I think the infrastructure that exists in New York is not going to sustain and or even meet even remotely the demands of the consumers in that state. I don't think this all happens, by the way, until latter half of 22, beginning of 23. So. I'd see we're going to have a slow rollout of this, and it'll be heavily medical until then, which is, doesn't, I mean, I don't know if you've ever bought cannabis in New York State, but it's pretty atrocious in the legal market. But I come from California. We have access to the best. But I think that, well, I actually come from Buffalo, New York, which is why I think New York matters to me so much. So I have a bit of a different opinion on it. I do think that it's for Columbia Care, I will say, has had early flags in New York. And so they've gone through this long process to get to this point where adult use happens. I used to run by their store in an amazing location in Brooklyn on my way to Soul Cycle in the morning when I lived in Fort Greene a couple of summers ago. And I was always like, oh man, that's going to be such a cool store when this all opens up. But I mean, the amount of foot traffic walking past that store at any time of the day, all I can think about is that greenhouse is going to be very well utilized to feed through their entire supply chain to even just fill, honest to God, that store alone, I think will do an enormous amount of business. And when you look at the people, the population per door that exists in this market already, it's going to be the highest number of people per door in the country by a long shot. And so I think this market's going to be a beast, and I think we need more infrastructure on the cultivation and manufacturing side to supply it, at least in the short term. And then, interstate commerce constantly is coming up. It's always a fear, and we have to think about how we divest of assets or consolidate our assets as we're investing into these operators. But let's not forget that one of the biggest motivators for why these markets are becoming legal is the tax money and job creation. And having grown up in Western and upstate New York, I can tell you that job creation is an essential aspect of that part of the state. It's been kind of a Rust Belt situation, and a lot of industry is pulled out for a number of reasons. But if cannabis can revive that, just like I saw it revive a town in Western Mass in Athol with Ascend, I mean, I'd be so happy to see that. And I'd also be happy to see the constituents of New York actually have access to good cannabis. So I'm pretty bullish on at least the near term building of it. Now, Sai, that you raised a great point about the Canadian build out of infrastructure, and it was at the beginning it was necessary. Like I remember we were early investors in Afria, and they were having trouble meeting the demands of the market, and that was a problem across the board, and that's why infrastructure. But this is where, when you're paying attention to how invest in or think about this industry, you have to pay attention to what's happening next. And to your point, I mean, at one point Morgan was like, "I think there's enough infrastructure in Canada for every man, woman, and child to smoke weed all day, every day," and they would still have too much supply. And I think we've seen kind of it flip on its head up there. But so it's just going to take prudence and mindfulness of the operators as they continue to try to look at the push and pull of supply and demand on these things.
Totally. Well, time will tell. Well, speaking of investments, another investment, we saw Red, White, and Bloom invest into Florida by purchasing some assets from Acreage for $60 million. The purchase, I believe, was some land, cultivation facility, and I don't think it nearly as big as what Columbia Care bought in New York, but still, cultivation and some admin office buildings. What's interesting here to me is, you see, Acreage, which was also an early mover, big name. And I feel like we're talking about Canopy a lot, Canopy Growth a lot in this conversation, but, Canopy Growth and Acreage made some headlines around a pretty unique structure on what would happen post-legalization in the U.S. and a way for Canopy to go beyond their Southern Glazers deal and really, create a footprint in the U.S. Should legalization happen with Acreage. And here we see Acreage retrenching and moving back to what they consider to be, their primary focus areas of the Northeast and Midwest, where they're, I guess, more capital efficient. It's interesting to me. I feel like Florida is a growing market, going to be it is a large market now, could very well be a similar New York model at one point. What do we think here? Is Acreage just going to do much better by focusing? Are they losing some advantages they may have in Florida by being there? Is Red, White, and Bloom jumping in the right way to what may be an exciting market?
I would say it's interesting because we have a changing of the guard in at Acreage, right? We pretty much have a new management team. So, you like to think that they're sitting and they're thinking about their strategy long and hard and what worked before and what they think will work now. Florida is an attractive market. I just wonder, with the shift in strategy, what does that do for the valuation of Acreage, and then what does that do? I don't recall the terms of the agreement with Canopy, but would there be, they'll obviously have to pay less than if they're shrinking and they're not, their valuation goes down.
I think there were minimums in the deal. It was like two share classes that they did where there's a fixed shares, 70% of Acreage. Canopy is obligated to buy, I think, at 0.3 times Canopy share price, something like that. And then 30% on these floating shares, which was $6.42, which I think is the floor on that. And there's like a higher on some weighted average price or something. But anyways, you're absolutely right. Like, what does this mean, right? I mean, obviously their share price has moved. I think from what I remember, the fixed shares is what everyone's trading. I think retail traders really haven't touched the floating shares. I think people are saying, well, 70%, the Canopy's on the hook to buy this should we see federal legalization, but you still see, movement there. And was this a good thing or a bad thing for acreage? But obviously, we're not in that boardroom. We don't have, the same information, and hopefully they're making the right choice. But it will be interesting to see red, white, and bloom coming in.
Because it's interesting because they have a guy from Pfizer who's, so to me that's like going down the medical lane, pharma lane. But I don't know.
Pfizer at acreage?
Yeah.
Or at red, white, and bloom? Oh, okay.
No, yeah, at acreage.
Got it.
I mean, Acreage has always been better at window dressing on their board than they've been at execution in their assets. So, I mean, John Boehner took a $20 million check and walked away, and the investors took a bath. And, now he has a book out talking about his experiences in the industry. I can't
How to make $20 million quickly.
Yes, exactly, and not create any value, and also to just let racist institutions remain in place. But I think that
Sounds like a good read.
I think we've read that book before. It's called Life. But yeah, no, I don't really have much to say other than I think they've always been about the press release. It's kind of like Monopoly, where they've got a bunch of stuff on the board, but it doesn't have any depth or like actual value to it. So I've always been amazed by the way money has flown in this space, and that's one of those enigmas to me. I won't really ever understand the attraction to it and why, but I just think it's about window dressing, and like people move in they move in herds, and they're like, oh, those people are just like me, or I want to be like them, and then I go and put my money there. So we didn't,
especially early on, when we didn't,
said no one
really,
ever.
particularly early on when there was only just a couple of people at the table, like you really, I don't know, everybody was so excited. Oh, I'll have what he's having or whatever, and not really understanding or thinking through, what everything's going to look like, 5 years, 7 years, 10, whatever.
Yeah. There's an analog to that, and it's called Theranos. And it's, there was a whole book about following window dressing into deals. And
that is a good book, actually.
Yeah. Bad Blood, definitely a good read. But yeah, so that's.
Well, yeah, speaking of window dressing or not, hopefully not, Cresco announced a new board member. And one of their founder board members retired. I believe it's Tarek Brooks, and I may be mispronouncing that. But what's really compelling is that he was the COO of account management and trading at Bridgewater. And for those that may know Bridgewater, the largest hedge fund, Ray Dalio, who also wrote a book. But I mean, that's a serious firm, right? Bridgewater, big name. But not only Bridgewater, he's also tasked with overseeing all business operations and investments owned by the one and only Sean Diddy Combs. So kind of quite a spread there. But sounds like, on paper, I mean, a real fantastic get for Cresco, right? Cresco's losing one of their founders, and I believe this founder from the board, and this founder, I believe, had some background in real estate, and maybe, the real estate stuff was probably very important day one. Now it's, brands and developing that, and, kind of having this lens to Sean Diddy Combs brands, which include spirits. So, obviously overlap there with beverage alcohol and cannabis, media, music, and consumer packaged goods of all things. So, it sounds like a pretty good get, and probably, much better than someone like a John Boehner, coming in. So I'm optimistic with this, but the question is this going to be a new trend? Is this going to be like a competitive advantage? Is it going to strategy? Who can attract who can have, top tier names, or really, maybe if not well-known names, at least people with real diverse backgrounds that, can kind of fill in some of, what's to be the future strategy of companies like Cresco.
I mean, I'll just share that on the boards that I'm on, we've worked really hard to try to attract people who have analog experience that they can apply to our industry. So maybe it's around manufacturing, distribution, products. So I think it does help. I will say, like, for example, one of the companies I'm on, there will be an announcement. We attracted a really interesting board candidate. And I really respected the way he went through the process because he was not, I would say he was certainly not in the I'm pro cannabis camp in terms of he had a lot of questions about what it means to participate in this industry. And I respect that process of like getting yourself truly comfortable with it, not just that you're jumping in for a quick return on your time, which is crazy, but the way some of that gets disproportionately paid out. But I think that, attracting good talent from analog industries is a good way for us to continue to round out what this industry looks like. We certainly need more diversity. That's definitely true. But I think we'll be seeing more of it. But I don't think I would just say that that's just a check the box for why to invest into a company, because I'd want to know that that person really spent the time looking at the company to make a really true decision around it. Like this person, he actually gave up he's very careful about how many boards he sits on because he wants to truly contribute time. And I thought that was also a really respectable aspect of his consideration set. So I think it's important to think about board composition and try to attract interesting people to bring new perspectives.
Absolutely.
So last bit of news here. As far as MSOs go, Ascend is going public. Made the announcement this week. Ascend, has a broad retail footprint in a number of states: Illinois, Michigan, Ohio, Massachusetts, and I believe New Jersey. And now they're going to be publicly traded soon. So it's a pretty big headline. Recently they made some headlines. They brought in Lowell Farms as a brand license. So that was, I think, a couple weeks back. We were talking about Ascend. So now here we are talking about public. So how do we feel about that? What's it going to look like? When do we expect everything to happen?
Well, I can tell you this. I think it's great that they got MedMen in New York right out of the gate, pretty much. And then that's number one. I don't know Abner Curtin. I've listened to him speak. He's very impressive. I don't know him from a hole in the wall, but when I listen to him speak, I'm very inspired. So I could tell you that I'm pretty bullish on Ascend. And well, the thing is too, is like, this is another example, right? This is another winner, right? That's emerging. Boom, done. Like I'm saying this, but obviously I haven't gone through all the filings and everything, but it just seems to me on the surface that from what I know of the company, they're making a lot of smart moves along the way. And, New York is a big thing.
New York is a big thing. Yeah, I mean, I think so. Just maybe more next week, we'll talk about this more. But this week, what I'll say is they went the extra mile in their process to go public. So instead of just doing an RTO or reverse takeover, which is a lot of what other groups have done, and they didn't really maybe even have the option to go another way, but Ascend chose to do both a GAAP and an IFRS audit of their financials, and they chose to also do a full U.S. prospectus, which you can now find because it's filed, and with a Canadian wrapper. So they'll be listed, and not like a Canadian like P. Diddy rapper.
I was going to say.
It's like, have you guys ever heard reggae?
You're talking about Drake? Like, is that code for Drake?
Yeah. But yeah, so they did it so that they could be as prepared as possible for when, uplisting is possible to the exchanges. So they're trying to run this like that, like let's be prepared for that moment. But I'm very excited for this to start trading. I think it's a great MSO with a lot of really solid assets. But yeah, I think we'll keep an eye out because it's going live next week.
So next week,
maybe we can see. Yeah,
we'll be able to cover more of that. All right. Well, yeah. I can't wait. All right. And last but not least, and not a bit of news, Matt, you published a recent kind of post-420 analysis kind of covering some of the MSOs there and where they're trading at.
Well, it's Q420, actually.
Right. But call,
use that pun.
Right, exactly. Yeah, to be clear, I should be clear, yeah. Well, how do people find the report? And then what are some of the big highlights?
Sure. Well, you can get this. It's in my blog post at the GreenWave Buzz, and it's at greenwaveadvisors.com. And what are the things I wanted to do? Because there's a lot of noise around GAAP and IFRS, and this is another reason why I think Ascend is awesome, because they had the thought to file under both because it's very confusing. So the big difference between the IFRS and the GAAP is accounting for biological assets, which is on many levels just ridiculous, but I don't want to get into it now because people might tune off. But bottom line is it's very confusing, right? It's even confusing for me, and I'm a friggin' accountant. So I really rolled up my sleeves and I crunched the numbers, thought about it, and really what's important is cash, right? Cash is king. So stripping out all the, accounting stuff, how much cash are these companies generating? And so what I looked at is the cash flow from operations. I got rid of or added back the cash taxes that were paid from the prior year. So you kind of normalized the cash flow. And then then there's a provision for the current year. So is there enough cash on hand that the business is generating on its own to pay this enormous tax? There's a very high cost of prohibition, right? It's not only the taxes, the 280E, there's an added compliance cost. There's added cost of debt that's not deductible. There's the list goes on and on and on and on and on, right? So those companies out of the gate, there's two for both years that I looked at because now we have 2 years of audited financial statements. So TrueLeave and GTI, both years they were able to generate enough cash to pay their taxes. To me, that's a big deal in this industry, in addition to paying all the other costs of prohibition. And then, so I kind of lay all this out. One of the other things I looked at, and I looked at really try to determine what the tax rate is on the cash. And some of these companies have paid up to 80%. 80% of their cash flow goes to taxes. So those guys that don't have that money effectively, they have to borrow money or raise capital just to pay their taxes effectively, right? And some of these have done this for 2 years. So the trajectory for everybody, there's improvement from 2019 and 2020. We'll see how this year plays out. But what I would say to that is the good news is for those stronger players, that gives them the opportunity to buy assets at distressed levels, because I don't think the industry the way it is right now, and it might be 2 years before 280 goes away, I have no idea. But the longer it goes on, the smaller become. And the better opportunities are going to be there for the stronger players because they'll be able to buy these assets at distressed levels. One good example, MedMen, $56 million on their books. They owe the IRS $56 million. And they had $6 million in cash. And so what did Ascend do? They went in and they got them. That was probably one of the considerations, is not having enough cash, on MedMen's part. I don't know. I'm just thinking, just analyzing. So that's going to be interesting to see what happens. Obviously, we've all talked about consolidation. As consolidation continues, that's going to cause variations in margins and earnings volatility. And I think, investors should not be surprised and don't freak out and sell your stock because one acquisition wasn't integrated. You have to think longer term. That's how I look at it. And then I would also say, when I look at comparative analysis, we're talking about Canada. The U.S., obviously, we all talk about it trades at a sharp discount to the Canadian LPs. But one other thing is when I look at a theoretical enterprise value of the industry, and that's it's a extrapolation of the top MSOs that are over $1 billion in market cap. The top MSOs trade at a discount to the industry. When I extrapolate that, I don't know if that makes sense, but the reverse holds for Canada. What's up with that? I don't know. It's not. I mean, the only thing I think of why Canada, one reason why they're at a premium is because their investor base. They have more institutions that are able to invest in the Canadian LPs because it's fairly legal. So you have more support. You don't have pension funds or whatever whipping these stocks around. They're holding them for a longer period. That might help some of the support the stock price. But by and large, it's not really. It doesn't make sense. But anyway. So that's my take this week on cash flow and my GreenWave analysis.
I love it. Yeah, I encourage everyone to take a look at it. There's a lot of good stuff in there. Matt, thanks for sharing that.
Thank you.
Yeah, fascinating the way some of this stuff just doesn't make sense in some ways.
And it's interesting now where we are because 4 years or whatever. I didn't know. There was no public information. It's kind of, going in the dark here. There's state information. You could get some information from the states, and many states are starting to provide more, disclosures or whatever, but it's not the same as looking, doing a deep dive into the company's filing. So anyway.
Well, I think this is a great place to end. Thanks for joining the High Rise. I did feel like that was a nice laid-back, data-backed conversation here. Thanks, Emily. Thanks, Matt. Always so much to talk about, and I know next week we'll have even more to discuss. I'm really looking forward to the Ascend headlines and seeing how that goes.
Awesome. Thank you so much. It's great to be with you both.
Thank you. Thank you both.
We'll see you next time.
All right. Over and out.